The latest 2025 property forecast that the media and property influencers are spreading, it's a lie. A big, shiny, data-drenched lie, guys. They want you to believe prices are about to soar, interest rates are falling, and the golden age of property is returning. But here's the truth, guys. Behind the glossy headlines and cherry-picked charts is a system doubling down on debt, inequality, and generational gaslighting. Because these so-called forecasts, guys, they're not here to inform you. They're here to condition you, just like Neo in the Matrix. So while the mobs in Canberra and the investor class cheerleaders that pump the market, millennials and Gen Zs are left staring at their dream home that they'll never own. In this video today, I'm going to unpack the latest 2025 property price forecasts and look at what they're saying, what they're leaving out, and how quietly they're screwing over millennials and Gen Zs, just like peeps that are watching this video. We'll break down today why the hype around rate cuts is a bait, how supply shortages are being weaponized, why prices are rising even though sentiment is still in the toilet, and the dirty truth behind the media recovery narratives. So if you ever read a property forecast like you read on news.com.au or realestate.com and then thought to yourself, wait, how's this good news? One moment is good, one moment is bust? What the heck is going on? Well, this video is for you guys. According to NAB, Westpac, and ANZ, we're getting multiple rate cuts this year. These big mobs from the big banking world, they are predicting that the cash rate will drop as low as 2.6% by early 2026. NAB even reckons we'll see a rate cut to 3.1% by August 2025. According to Sally Ord, the NAB chief economist, she quotes, "They're building headwinds, but we expect a soft landing," end quote. And according to Peter Monkton, another bank mob, which is BOQ's chief economist, he says, quote, "Falling interest rates will boost borrowing power and prices," end quote. And my take on this, guys, that's not optimism, that's just bait. Because think about it, guys, who benefits on these rate drops? Not the first home buyers, not renters, but cashed up investors who've been waiting to pounce. A majority of them, my clients. But let me say bluntly, guys, rate cuts are Tinder matches for boomers with equity at the moment. And unfortunately, guys, they don't swipe right on you. While another one of my clients bought in Paddington just last week and it's off market, while other newbie first home buyers are still refreshing their pre-approval. Yes, I'm talking about you clients out there who got a pre-approval and not action at the moment. Start actioning before you lose out, guys. On the flip side, guys, meanwhile, a couple I spoke with in Craigieburn who bought an OTP, which is an off-the-plan property, they bought a townhouse in 2022. And you know what, guys? It just got valued $70,000 below what they paid for. And you know what burns, guys? They use a 5% first home buyer scheme. And I don't know whether you guys know, right? The first home buyer scheme allows you to borrow 95% of the valuation price, not the contract price. So right now, they bought it at this price and it's valued at $70,000 lower. The bank's going to lend the money on 95% of the lesser $70,000 of that property. Now that is sucked in. And right now, they can't refinance and they can't sell without a loss if they do keep this property. And just on the note of speaking of equity, guys, let's talk about supply at the moment. Or more accurately, the myth of supply fixing everything. Right now, we've got a so-called shortage of 200,000 dwellings, according to conservative estimates. Yet building approvals have dropped to a decade low at the moment. And from my inside knowledge, developers are shelving projects left, right and center. According to the Australian Bureau of Statistics, they quote, "We're about 250,000 homes short of current demand," end quote. And according to CoreLogic RP data, they say, quote, "We got a population growth of 660,000 last year and completions are running at 170,000. End quote. But guys, here's what they don't tell you. This isn't a crisis. It's a business model, guys. Because less stock means more competition. Because less stock equals more competition equals higher prices. Are we following along at the moment? My take, guys, the shortage isn't accidental. It's engineered. And it's a golden goose that's laying unaffordable eggs at the moment. From my own inside knowledge, some markets are reflecting this artificial squeeze better than others. Like in Perth at the moment, suburbs like Baldivis, sorry I can't pronounce it, and Byford are clocking 12 to 14% annual growth, while newer estates in Ellenbrook have already run ahead of its fundamentals. For example, my client in Como in 2023, their home jumped $180,000 on paper. There was no reno, no gimmicks, just basically tight listings and migration demand that boosted that growth. Meanwhile, guys, outer ring suburbs like Tarnet, and Mickleham, those suburbs have stalled. On the same sentiment, guys, one investor client told me after buying a dual occupancy in Como, he originally expected high rental yields, but at the moment, his rental yield, even with dual income, is under 3.5%. And currently in Como, the resale demand is evaporating. So as you can see, guys, different investors playing different games. For this person in Como, that's not investing. That's more like donating. And while we're on the topic of supply, guys, while supply gets tighter, prices are going the other way. And this is where I'll segue and talk about the psychological warfare of price optimism. Because naturally at the moment, home prices rose 0.5% in May. That's up by 4.12% year on year, according to PropTrack. And at the moment, CoreLogic confirms Brisbane and Adelaide are leading the pack, up by 7.1% and 8.6% respectively. To quote PropTrack Home Price Index, quote, prices have now grown for 5 consecutive months, end quote. And according to RBA, the Reserve Bank of Australia, they say, quote, 50% of Aussie homeowners have no mortgage, end quote. And this is according to May 2025 RBA data. I'm not making this up. But then you might be scratching your head and go, Q, how is that possible when consumer confidence is in the gutter? Because guys, remember, confidence doesn't drive growth. Do you know who does? It's the rich buyers. And then from that group of people, that top 10% of that group, and those guys are shopping around for their 5th property, that type of economic activity distorts everything, guys. And this is my take. This isn't a market recovery, guys. It's a wealth transfer dressed up as a rebound. I mean, guys, let me give you some examples, right? Let's look at suburbs where this wealth transfer is playing out at the moment. For example, in Brisbane, family-friendly areas like Carina Heights and Everton Park are 9% year on year. And I'm talking about capital growth, guys. And even as borrowing capacity shrinks at the moment, and this is coming from live experience because I've just serviced over 300 clients this month alone, I'm telling you guys, borrowing capacity is really harsh. It's really hard to get a loan these days. But if you can get a loan, if you can squeeze in through my holistic lending, just to give you an example, one of my investor clients, they recently picked up a 4-bedroom house in Keperra. Sorry, I can't pronounce it. K-E-P-R-A. That's how I pronounce it. Keperra. Last August. And then they simply added $25,000 of cosmetic reno. We just did a valuation today. They got an uplift of $120,000 from that $25,000 of cosmetic reno. But on the flip side, guys, meanwhile, those suckers that bought in Docklands, those units over there, those people who don't listen to me, they are struggling at the moment. Because I'm telling you at the moment, those guys that bought in Docklands, those units over there, I'm telling you right now, Docklands is experiencing an oversupply and is practically becoming a ghost town. And for those of you that are watching right now, if that wasn't cooked enough, wait till you hear what the banks are forecasting. According to BOQ's chief economist, Munchton, he reckons we'll see a 10 to 15% growth over the next 2 years. To quote Peter Munchton, he confirms, quote, it's a reasonable bet, regardless of the numbers of the rate cuts, end quote. Like, this guy is super confident property growth will go through the roof. And according to the RBA bulletin, they said, quote, most borrowers have buffers of equity at the moment, and they can weather the storm, end quote. And guys, from all this gibberish, like you don't understand it at the moment, let me translate it to simple English. It means just don't worry about the economy. The rich are fine. But if you're not one of them, sorry guys, your poverty ass statistics are being left out from their spreadsheets. But seriously, guys, this kind of forecast, really for myself as an investor, this makes all my investor clients froth. Like, what I'm talking about at the moment is that this environment makes buyers panic. Like, it creates this FOMO volcano. Even in my local suburb, Sydney, I'm telling you guys right now who are watching this, it's wildly uneven. Like, in the last 6 months, Tempe and Merrittville rose nearly 6%. But not all suburbs are growing equally because, for example, like southwest fringe areas like Austral, those areas are stagnating. For example, I had a client buy in Homebush West in 2021. Suburbs like Homebush West and the Ripple suburbs, those areas are flatlining at the moment. And right now, with interest rates falling, investors are leapfrogging those suburbs at the moment, and they're going for more trendier and more gentrifying pockets. Because I'm telling you guys, when interest rates drops, with more lending in hand, investors are more picky. And this is where in this video, I'll bring you to the most dystopian part of this mess, the housing ladder myth. Because according to Alba's new policy, who lets first home buyers buy with just 5% deposit, no income cap, that's coming in 2026, guys. And no mortgage insurance, allowing you to borrow 95% of the bank's money, which is currently in place in this first home guarantee scheme at the moment. Our PM, Anthony Albanese, he says, quote, this policy turbocharges access to the market, end quote. But according to Seoul Estate, the economist, he counters, quote, but the extra demand without extra supply will only push up prices further, end quote. And guys, this is my take. This is not a ladder. This is actually a treadmill, because unfortunately, first home buyers are not just competing with investors, and they're also competing with upsizes and downsizes, and all the while using taxpayers' guarantees to inflate the entry-level prices. Do you guys see the oxymoron in this? No pun intended when I say moron. Because right now, for you guys that's watching this, that's priced out of the market, I'm telling you, you're not being helped by the government. I'm telling you, you're currently being herded. That's right, guys, I said it, you're being herded like sheep and cows, and like those plugged-in human bots in the Matrix, you guys are funneled into debt oblivion, and at the end of that, you've been given a ribbon that says, you made it. So right now, let me roast this nonsense properly, guys. Because the mobs in Canberra, they act like they can fix affordability with grants while actively inflating demand. And then those bank economists that I've just quoted just then, they sound more like cheerleaders than analysts. Like when they get interviewed in articles and they say, oh, soft landing, that's just a secret code between their rich buddies, which translates to, oh, we'll be fine, but screw the rest of you, end quote. And don't get me started on the media headlines. News sites like news.com, realestate.com, Domain, the Australian and Australian Financial Review. These guys flip up their headlines more than a fish on a Jetstar flight. Like, for example, one week it's a crash, next week it's a boom. Like, make up your bloody mind. And don't get me started on investor gurus that's on IG, TikTok, and LinkedIn at the moment. Like, I'm getting really angry at the moment. I'm seeing those guys selling $800,000 off the plan apartments in fringe suburbs that's currently, from my observation, yielding 2.2% yield. And I'm thinking to myself, guys, that's not investing. That is just bait for the naive. So guys that have watched thus far, you are real avid fans. I respect you for watching this long video. But you might be scratching your head and asking, hey Q, so what's the real forecast then? Okay guys, real talk. Let me summarize it. At the moment, in June, like I'm recording on the 14th of June, 9:59 a.m. I'm telling you right now, prices will keep rising, but only for people who already own property. People like myself with 8 investment properties. And no, I'm not bragging. I have clients that have over 50 investment properties. In this economic climate, in terms of property, those that will win is for those that have property at the moment and they've bought many years ago. For myself, 15 years ago. But before you click on and go, oh man, what about us guys? What about us noobs? Let me tell you, there's still hope. Keep watching. I want you to consider at the moment what I just said in this video, right? Take a deep, long walk and think to yourself, do I want to be played by this game? Or do I want to rig this game to benefit my family and build generational wealth? If you do, I suggest you book a 50-minute strategy call or a 60-minute deep dive for me to create a holistic lending solution for you with the help of my financial advisors, my accountants, and my respected buyer's agent to help you build an A-team so that you can rig this game for your benefit. And at the end of it, guys, if you're not ready, just hit the like button, hit the follow button, and most importantly, smash the share button. Share this knowledge to your mate, because I'm telling you guys, knowledge is power. And again, thank you for watching another episode of That Property Roast, and I'll see you in the next few days.